Hey guys, hope you and your families are doing well. Jack Corsellis here. I'm going to be explaining to you types of Japanese candlesticks that appear time and time again in optimal chart patterns. So these are going to be cup and handles, they're going to be VCPs, they're going to be Darvis boxes, they're going to be flags as well. And I'm going to be explaining these 6 type of Japanese candlesticks you just see occur time and time again, but doing it so from a supply and demand perspective. So this is not stuff you're going to read in any book that you've read on trading. This is from my own experience, but I really want to deepen your knowledge of what is actually going on from a supply and demand perspective when you're seeing these candlesticks and the interrelatedness with the volume. MarketSmith are the sponsor of this video. Discounted trial available in the comments below. Let's jump straight on into it with BRCC, which formed a cup and handle earlier in 2022. So first and foremost, the 6 Japanese candlesticks you're going to see occurring in optimal chart patterns. These occur because there's obviously accumulation going on, there's shaking out of weak hands, there's absorption of supply drying up, there's large operators moving into accumulation type characteristics as well. So everything we're going to be studying here is from a supply and demand perspective. So what are the 6 candlesticks that I pay attention to when I'm analyzing the quality of the base? The 6 are going to be a trigger bar, a tight range bar, a shakeout demand tail, a gap down reversal bar, a bullish synchronicity bar, a bullish ease of movement. And I'll explain each of those now, and then we'll start looking at them in the context of the chart in a little bit greater depth, and we'll work through some of those other examples. Celsius, a few VCPs, CODX, that there is a flag type band. So a trigger bar for me is actually the final bar within a base before I'm targeting an entry. So a trigger bar to me signals that there is very little supply coming to the market. Now, how do I recognize that? What am I looking for when I look at the candlestick and the volume? I'm assuming that a VCP, a cup and handle, a flag, a Darvis box, so on and so forth, has actually formed. Then I'm watching and waiting for that trigger bar. So a trigger bar is going to be a narrow range candlestick. Usually it may resemble a doji, or it may be very narrow in terms of the real body. The overall spread is narrow as well. It can have a strong close as well. So you see this final trigger bar here, it's actually just closing on the high of the bar, but on a relative basis this is a very tight candlestick, and the volume is below the 30 bar average, which is that black line. And you see how the volume had actually been stepping down into that as well. So the trigger bar is kind of that final piece of the jigsaw puzzle, if you like, for me, that's indicating, okay, no more supply coming to the market. Now I'm targeting a breakout. Jesse Livermore, the line of least resistance has formed, if you like, as well. No more supply. This is where I'm then looking to target. Usually it's through the high of a trigger bar. Maybe it's a high of a recent bar, but certainly around the high of the trigger bar. Stop loss is then usually placed underneath the low of the trigger bar and or a key moving average or two. Depends on the quality of the setup. What is a tight range bar? So this is where we can really get into the weeds of supply and demand. So a tight range bar, as the name implies, is a bar that is tight. So invariably the real body will be tight, but you may see evidence of a demand tail as well. So what is a demand tail? You see, such as this bar here on this shakeout, on this shakeout demand tail bar. You see how you get this demand tail coming down. So price goes down during the session and then is being bought back up, especially if this is happening under one or more key moving averages. So you may see a shakeout demand tail such as over here underneath, say, the 21 EMA. You may see it, if it's a bigger base, a longer base, you may see it underneath, say, the 50 SMA as well. If it's a much quicker stock, you may see a shakeout underneath the 10 EMA, so on and so forth. But a tight range bar will often have a real body that is very tight, and you may also see a little kind of shakeout demand tail attached to it. Now, depending on the volume on a tight range bar, this also goes for a shakeout demand tail as well, will tell you how much supply is around. So I like to think of volume as weight. So there's always weight going on. There's the weight of supply and there's the weight of demand as well, and every candlestick is in and of its own right a scale. So obviously there's a scale going on, how much weight is on the supply side, how much weight is on the demand side as well. So if you see a tight range bar that has low relative volume, so this one here, I'm actually, just for the purpose of this, it's a shakeout demand tail, but it's also a tight range bar as well. So I'm just going to point to this with an orange, and then I'm just going to point to, say, this one here with a purple. So you can just see the difference. And what we're going to do is we're going to draw a purple arrow to this one here. Okay, so then I can explain the difference to you for what is actually going on from a supply and demand perspective. So on the first tight range bar, this purple one here, the size of the real body is about the same as the orange one, and the length of the demand tail is about the same as well. However, on the purple one, volume is around about half the 30-day average, whereas volume on the orange one is actually a little bit above the 30-day average, so it's about twice that of the purple one. So on the tight range bar, which is purple, I know it's not purple, it's obviously green, but where I'm pointing to it with purple, that is indicating there's very little supply around, because it's a tight real body, little shakeout demand tail in the context of a basing area, and volume is below the 30-day average. However, Over here on our orange one, it is pretty much the same candlestick. The characteristics are pretty much identical, but the volume is twice that of the purple, indicating that the effort going on there, the weight of supply and demand, is greater. So this one here, because of the characteristics of the candlestick, little thin real body, shakeout demand tail, indicates that there is absorption going on. So this is the same when you see a tight range bar and also a shakeout demand tail. The level of volume will tell you how much supply is around. So in terms of a base, you would actually like to see a couple of shakeout demand tails in there, but volume is below the 30 bar average. Why? Especially if it's shaking out underneath a key moving average, say the 21 EMA or the 50 SMA. Why do you want to see the low volume? Because the intention of these shakeout demand tails is to shake out weak hands. But if there's very little relative volume, what is it telling you in terms of how much supply is there? It's telling you there is not much supply there. So then if a subsequent pivot point sets up, you get a couple of tight range bars coming through, you get a trigger bar coming through, that there could indicate a very high quality setup if you've seen the cup and handle, the VCP, the flag, so on and so forth form as well. So we covered tight range bars there, we covered shakeout demand tails. Let's cover a gap down reversal bar. So gap down reversal bars, I actually think tell us a lot in terms of the presence of demand. So there's only one on this one. There's a better one when we move forward. Let me go forward actually, and let's go on to this one here. I'll flick back in a minute to BRCC. So we're on Celsius here. Now this is the gap down reversal bar I'd like you to focus on. I'm going to put it in purple. So this here is a gap down reversal bar. Now what is a gap down reversal bar? It's similar in a way to a shakeout demand tail, but the characteristics are a little bit different in terms of how a gap down reversal bar works. So if you take a look at the prior day, and because I kind of close off the tab, they've gone a little bit skew for some of these, so apologies about that. But you see this bar here, the gap down reversal bar. The prior bar is a tight range bar where price actually opens on the low of the day and then it closes on the high of the day. Volume is low as well, and it just closes above the 21 EMA. Now for the gap down reversal bar, price actually gaps down, it undercuts the recent low here, gaps down underneath the 21 EMA. But what do you notice about where the open of that bar is? The open is the low of the day, then price pushes up. So what is that telling you from a supply and demand perspective? To my mind, it's telling me that there is evidence that demand is there, demand is present, and immediately as that liquidity and perceived value, the two things large operators require above everything else, as soon as that is becoming available, they're stepping on it and they're buying up the shares. They're soaking up the supply. Now another thing, as we touched on with the shakeout demand tail, is the level of volume tells us how much supply is there. So if you take a look at the volume on this gap down reversal bar here, what do you notice in terms of the volume? Let's make that purple. What do you notice in terms of the volume? It's a half, a third versus the 30-day average, and the intention of a gap down reversal bar, similar to that of a shakeout demand tail, is to shake out weak hands. Okay, scare them out, flush them out, and then reverse the price high. So when you see a gap down reversal bar like this, especially if it gaps down, open is on the low of the day, then demand stepping in immediately, so then price is pushing up high. You can see it with this bar here as well. There's this hammer type candlestick that forms here, then price actually gaps down to the 21 EMA, pushes back up very, very quickly. You then see it here as well. There's actually another gap down reversal bar here, another one occurring over here as well. Gaps down, open is the low of the day, and then pushing up. These are good type of candlesticks to see in these optimal bases. Again, this is drawn from my own experience of just studying thousands, tens of thousands, hundreds of thousands of these. If you go and do this and make your own observations, I imagine you will find something similar, that in terms of these bases that set up and can lead to very powerful breakouts, as much as the patterns repeat, there's then repeatable characteristics that go on in terms of the Japanese candlesticks. You could do this with bars as well if you want. I think Japanese candlesticks have a wealth of information you don't necessarily get from kind of standard bars, hence why I like using the Japanese candlesticks. I think you learn much more in terms of what is going on from a supply and demand perspective, especially when you're then overlaying that with the volume, looking at relative strength as well. It's a stock leader. You can see Celsius both times here, 52-week highs before the breakout, indicating the stock is a leading stock. So let's just go back over to BRCC. And then the other one that I want to talk about is what I call there's two more actually, a bullish synchronicity and a bullish ease of movement. Now these two are basically the same in terms of the characteristics of the candlestick. It's going to be a wide real body on a relative basis. So we have a bullish ease of movement bar here, and then two bars later, well actually the next bar and the next are bullish synchronicity bars. Now the only real difference between a bullish synchronicity and a bullish ease of movement is the level of volume. So you can get these widespread candlesticks that actually happen on low volume, where price is opening near the low of the bar, pushing up, closing strong near the high of the bar. That real body is wide on a relative basis, but volume is below the 30-day average. What is that telling you? It's telling me that there is very little supply around, so price can easily move up, hence the ease of movement nature. Now obviously you get this on the opposite side of the coin. You can get bearish ease of movement as well, where price can just easily move to the downside because of a lack of demand. So that there is something else to also be looking for. You actually get a bearish ease of movement bar coming through here, but then an immediate shakeout demand tail, then just tight range on declining volume just indicates very little supply that's coming to the market. So a bullish ease of movement and a bullish synchronicity bar are very, very similar in nature. The only difference is the level of demand required to push price higher. That is going to be indicated to you by the size of the volume on a relative basis. So you can see here the volume is actually stepping up, indicating it's taking more effort for demand to make this, or for price to make the same movement to the upside, indicating the presence of supply. And then you go tight range, and actually the spread is narrowing. You get a little shakeout demand tail, then an even smaller shakeout demand tail, and then you get this final trigger bar here. Volume steps down, so supply is just being absorbed, very little supply coming to market. This is then how you can create very asymmetric reversible trades. Then if you can look to time your entry points when you're when you're getting the evidence that demand has become dominant, bullish ease of movement, bullish synchronicity bars, and then those tight range candlesticks coming through, whether you're looking at the monthly, the weekly, the daily, the 1 hour, the 15-minute, it's all just supply and demand if you're trading these cup and handle flags, VCPs, Davis boxes, whatever. But these are the type of setups I like to be looking for. Let's go and do a flag. So it's a little bit different in terms of a flag type pattern. Let me just clean this up a little bit. Let's do something like that. So we're going to see here a couple of shakeout demand tails. So the stock makes a big move. We then have a shakeout demand tail in here, gaps up, shakeout demand tail on that bar, shakeout demand tail to the 10 EMA. We then start putting in a tight range bar. We then have a bullish engulfing, bullish synchronicity candlestick. We have another bullish synchronicity candlestick, and then this is just an observation. There is clearly demand in the driving seat here, and then what happens in terms of the type of candlesticks you're seeing? Tight range. For the majority of these, there's actually a little shakeout demand tail underneath the 21 EMA. Then you go and put in this perfect trigger bar. It's an inside bar. Price actually opens on the low of the day, pushes up. Volume is a quarter versus the 30-day average, roughly. This is then just indicating no more supplies coming to the market. So then the entry is through the higher there, stop loss place just underneath the low. Then obviously the stock explodes out. Does the stock then explode out every single time? Of course not, but you want to be training your eyes to trading those highest quality setups. That is both thinking in terms of the chart pattern, VCP, cup and handle, flags, Davis boxes, so on and so forth, but then taking it a step deeper and understanding the optimal type of Japanese candlesticks you want to be seeing inside of those bases. What is going on from a supply and demand perspective? It'll just help you trade, I think, the better quality setups out there. So I really hope you guys have enjoyed that video. Please like it. If you do, leave me a comment down below if you have any questions, and as always, look forward to seeing you in a future video.